You walk into your bank on a Tuesday morning, clean floors, polite tellers, everything feels solid, safe, normal. But here's what nobody tells you. If everyone in that lobby tried to withdraw their money at the same time, the bank would collapse in less than an hour. Not because it's poorly managed, not because of fraud, but because that's exactly how it's designed to work. And according to a 2023 Federal Reserve survey, 84% of Americans now say they feel some level of anxiety about the safety of their deposits. That's not paranoia, that's pattern recognition. So what do they know that you might not? Let's start with a number that sounds impossible. Right now, there's about $18 trillion in total deposits sitting in U.S. banks. That's money people think is just sitting there, waiting for them in a vault somewhere. Savings accounts, checking accounts, the money you worked for, but if you went to your bank today and asked to see your money, they couldn't show you, because it's not there. In fact, on average, your bank only keeps about 3 to 10% of your deposits in actual reserve. The rest, they've already lent it out. 2 strangers buying homes, 2 businesses expanding, 2 credit card companies fronting cash to someone who just bought a couch on installment. This system is called fractional reserve banking, and it's been the foundation of modern finance for over a century. It's not a secret, it's not illegal, it's the entire point. But it only works if you don't think about it too hard. Here's how it actually functions. Let's say you deposit $1,000. The bank is required to hold maybe 100 of it in reserve. The other 900 that gets loaned out to someone else, that someone buys something, the seller deposits that 900 into their account. Now the bank takes 90% of that and loans it out again. $1,000 in deposits can become $9,000 in circulating money within a few cycles. It's called the money multiplier effect, and economists love it because it creates liquidity. It greases the economy, makes credit cheap and available. But there's a catch, a pretty significant one. That system assumes that not everyone will want their money back at the same time. It's a bet, a calculated gamble that relies entirely on collective.com. And when that com breaks, the entire machine stops working. March 2023, Silicon Valley Bank, a mid-sized bank with $209 billion in assets, not a household name, but solid, trusted, used by nearly half of all venture-backed startups in the country. Then someone noticed something. The bank had invested heavily in long-term government bonds, safe assets, except bond values drop when interest rates rise, and rates had been rising fast. So a few venture capitalists started quietly telling their portfolio companies to pull their deposits, just to be safe. A whisper campaign on private Slack channels and group texts. Within 48 hours, customers tried to withdraw $42 billion. That's a quarter of the bank's total deposits. In 2 days, Silicon Valley Bank didn't have $42 billion sitting around. No bank does, so they had to sell those bonds at a massive loss to cover withdrawals, which made the panic worse. Which triggered more withdrawals. The bank collapsed in less than 60 hours. The second largest bank failure in American history. Not because of a crime, not because of a scandal, because too many people asked for their own money back at the same time, and here's the uncomfortable part. They were right to be worried. Silicon Valley Bank wasn't an anomaly, it was a preview. 2 days later, Signature Bank failed. Same mechanics, different trigger. Within a week, First Republic was teetering. The financial press started using phrases like contagion risk and systemic fragility, which is polite language for this could spread. And it almost did, until the federal government stepped in and made an announcement that should have raised more questions than it answered. They said that all depositors at Silicon Valley Bank would be made whole, not just the ones covered by FDIC insurance. All of them, including accounts with $50 million, $100 million, $200 million. Now, FDIC insurance is supposed to cover $250,000 per account. That's the safety net. But suddenly, the rules changed mid-crisis because the alternative was letting panic become contagion and contagion become collapse. So the government essentially said, we'll print whatever money is necessary to stop this from spreading, which worked. The panic stopped, markets stabilized, but it also confirmed something a lot of people had suspected for years. Your deposits aren't safe because of the bank's balance sheet. They're safe because the government is willing to intervene when things go wrong, which raises an obvious question: what happens when the government can't? Let's talk about the FDIC for a second. The Federal Deposit Insurance Corporation, the agency that's supposed to protect your money if your bank fails, It was created in 1933, right after the Great Depression, when more than 9,000 banks collapsed and millions of Americans lost everything. The idea was simple: insure deposits so people don't panic and pull their money out at the first sign of trouble. And it works, most of the time, because most bank failures are small and isolated. A regional bank goes under, the FDIC steps in, moves the deposits to a healthier bank, and life goes on. But here's the math that keeps regulators up at night. The FDIC's insurance fund currently holds about $128 billion. Sounds like a lot, until you remember there's $18 trillion in insured deposits across the country. That's a coverage ratio of roughly 0.7%, less than 1%, which means if even a fraction of the banking system failed at the same time, the FDIC wouldn't have nearly enough money to cover it. They'd have to borrow from the Treasury, which means the taxpayer, which means you. And that's assuming the Treasury can borrow fast enough and that foreign creditors still want to lend to the US government at reasonable rates, and that inflation doesn't spike when they start printing emergency money. A lot of assumptions, all of them optimistic. Now here's where it gets quietly absurd. After the 2023 bank failures, did anything fundamentally change? Did Congress tighten reserve requirements? Did regulators force banks to hold more capital? Not really. There were some stress tests, some new reporting rules, a lot of speeches about resilience and oversight, but the core system stayed the same. Fractional reserves, massive leverage, a financial architecture that only works if everyone stays calm, because the alternative would be redesigning the entire economy. And nobody wants to do that. It's too expensive, too disruptive, and frankly, most years the system works fine. Until it doesn't. And that's the gamble. The silent agreement between banks, regulators, and depositors. Everyone pretends the money is there, the bank pretends it can cover withdrawals, the government pretends it can backstop any crisis, and as long as nobody tests those assumptions all at once, the whole thing holds together. But the 84% of Americans who say they're anxious about their deposits, they're not wrong. They're just paying attention. Because the last 15 years have been a masterclass in what happens when trust evaporates. The 2008 financial crisis, the 2020 liquidity crunch, the 2023 bank runs. Each time, the system came within inches of a full collapse. Each time, emergency intervention pulled it back from the edge, but every intervention makes the next crisis more expensive, more complex, harder to contain. So, what's the actual risk here? It's not that your local bank is about to explode tomorrow. It's that the system has become so interconnected, so leveraged, and so dependent on confidence that a crack in one place can spread faster than regulators can react. Think about how Silicon Valley Bank collapsed. It wasn't a slow bleed. It was $42 billion in withdrawal requests in 48 hours, executed digitally. No lines outside the bank, no photographers capturing the panic, just clicks on a screen. That's the new shape of a bank run. Silent, fast, impossible to stop once it starts. And the triggers are everywhere. A geopolitical shock, a jump in interest rates, a viral tweet from the wrong person at the wrong time. The financial system is stable right up until the moment it isn't. And when the next crisis hits, the FDIC's $128 billion fund won't be enough. The government will have to step in again, print more money, backstop more losses, which works until it doesn't, until inflation becomes a problem, until foreign creditors lose confidence in U.S. debt, until the cost of intervention becomes greater than the cost of collapse. Nobody knows where that line is. We just know we keep moving closer to it. Here's the part that doesn't get talked about enough. The people running this system aren't idiots. Central bankers, treasury officials, bank executives, they know the math. They know the risks. They know the whole thing is held together with duct tape and optimism. But they also know there's no better alternative that doesn't involve a complete redesign of how money works. And redesigning money mid-flight is a recipe for catastrophe. So they manage the risk, they run stress tests, they adjust reserve requirements at the margins, they hope that incremental fixes will be enough to keep the system from tipping over. And mostly, it works. Most years are boring, most banks are fine. Most people get their deposits back when they ask for them, but mostly isn't the same as always. And the gap between those two words is where 84% of Americans now live. Not in full panic, just in low-grade unease. the sense that something fundamental isn't quite right, and they're correct. Because the system isn't designed to be safe, it's designed to be efficient, to maximize credit, to keep money moving. Safety is a byproduct, not the goal. Which is fine until it's not. So here's where we are. Your money is in a bank that doesn't actually have your money. It's insured by a fund that couldn't cover a real crisis. It's backstopped by a government that can print money until inflation becomes a bigger problem than bank failures. And 84% of Americans sense this, even if they can't articulate exactly why. The system works because we believe it works. The moment that belief cracks, the machine stops. Not slowly, not with warning, just stops. And the strangest part, everyone involved knows this. They just hope you don't think about it too much. So the question isn't whether your bank is safe today, it's whether collective faith can outlast the next shock. And nobody actually knows the answer to that. They just hope we never have to find out.